Today is a great day for Wall Street and the 29 underwriting banks. Just to follow up on some of that thought, the range was raised to 70-72. So looking at it, is it going to make a double-digit % gain today or 9%? I don't think that matters. I think what really matters was what we saw with the ability of the syndicates to come together to really produce a great IPO today and the technology to really support it.
But we didn't hit 80, we didn't hit 90, we didn't hit 100, or we didn't hit 90, we didn't hit 100. Is there an argument that that's a good thing? I'm only thinking about the other companies listing who, again, they don't want to leave money on the table, but they want to make sure that there's going to be enough interest.
Yeah, it's a balance to try to figure out what to leave on the table, what not. On the first day of the roadshow last week for Lyft, it was oversubscribed. And I even lost track of keeping 20 times, 30 times oversubscribed. That's an excellent, excellent signal for the other tech companies waiting in the wings to IPO.
All right, Stephan, what do you think about Lyft? Not only how it's gone today as an IPO, again, an important one for the NASDAQ, a bellwether for everybody else this year, but how does the business look to you?
Well, I mean, I'm a happy customer of Lyft, and I think they've had way fewer missteps than Uber, and I think they although they have been the David to Uber's Goliath, I also think that Lyft has successfully elbowed their way in and doubled and tripled the revenues over the last few years and captured half the U.S. market. And really, we're in an economy where everything is moving to ride sharing and eventually automated driving. Therefore, the upside potential is enormous, even with competition. And I'm just happy for them, by the way. I just want to mention, speaking of IPO pricing pops, that they barely left any money on the table. If you guys remember the days of theglobe.com, it went up, 1,000% on day one. So talk about leaving money on the table. That was a disaster. These guys did it really, really well.
John, that again goes back to the underwriting process, but also to kind of the retail public and the interest that they might have in participating, not only in today, but kind of hanging on to this thing. What is the case for Lyft as an investment here? Look, it lost still $900 million last year. I've heard people describe it as a duopoly, but there's really no barriers to entry for this. It's ride-hailing from an app. And Uber, meanwhile, has other business lines. They have Uber Eats, they have Uber Freight, they have different things going on. Aside from the sort of hazy future of autonomous driving, what is the case for owning Lyft today?
And again, add in Uber Air, but in Lyft, more of a domestic play. But there is a bid to Lyft today for a reason. Investors are getting involved for a reason because of their growth potential. So there is an excellent case to be an owner of Lyft today.
Well, the growth potential can be a double-edged sword, though. If you grow more and you lose more. Now, Stephan, they have trimmed their losses relative to their revenues as they've grown. Do you think it's fine for investors to invest in a company that's still losing money as long as there's a path to profitability? Or are some just saying, look, I believe that these guys are going to figure out a way?
Of course. I mean, most dot-coms you've heard of today that are public companies were losing money at one point. Everyone's losing money in the beginning, and one of the most famous dot-com money losers was Amazon. So you as a shareholder, you're betting on the team that they know what they're doing. From the interview that Andrew Ross Sorkin just did with the co-founders, they know their unit economics. They believe in their unit economics, and anyone on the roadshow who's seen this knows that there is a lot these guys can do to grow their top line and eventually trim the bottom line, and that's the name of the game.